Okay, this next tutorial is concerning the last two adjustments entries, which are first of all allocations. And allocations are really allowing for or recording for debts that are bad, which means debts that somebody has purchased something from you or a service and they're not going to pay you. Okay, so that's a bad debt. So bad debts, here we go. There's really two steps to recording bad debts. So as soon as you think that an account might not be collectible, then the first step is to looks like this. So let's say on December 31st, and usually as a certain percentage, it's 1% of all your accounts receivable or 2%. There'd be some kind of industry average that would you be able to say that we think we can't collect on this amount of debt. So on December 31st, the company realizes that there's about $2,000 of accounts receivables that they're not going to be able to collect. Somebody's not going to be able to pay. So they would debit a bad debt expense, the amount, the $2,000, and then there's an account here which keeps track of how much, then they're called doubtful accounts, so allowance for doubtful accounts, accounts that we think might not be paid. We don't know for sure, but perhaps they might not be able to. So bad debt expense is really, again, you're keeping track for your income statement. It is an expense, just like when you buy supplies or pay for insurance or rent or whatever. Those are still expenses. And so the $2,000 here is keeping track of temporarily how much we're going to allow for debts that we don't think we can collect. Then at some point the company will realize that a certain amount of time has passed by and the debt is definitely not going to be able to be collected. So let's say on February 28th, we would remove that amount, the $2,000, from allowance for doubtful account. Allowance for doubtful account is just a temporary account that we're keeping track of how much we think we might not be able to collect from our the people that has purchased services or goods from us, our customers. And so we would remove that from the allowance for doubtful accounts credit account, so we debit it, and then accounts receivable would get credited $2,000. So in the end, we have $2,000 that we sold to some customer and we don't think we can collect on. So we can't collect on it, so it goes into a bad debt expense, which for the purpose of income statement. And then remember, accounts receivable is normally where you keep track of what your customers owe you. So then there's $2,000 there that we're not going to be able to collect on, and so that's why accounts receivable would be credited $2,000. If there wasn't any time frame between the two of these, then there would be one entry, bad debt expense $2,000, and then accounts receivable would go down $2,000. Okay, but there's usually a certain period of time where okay, maybe we can't collect on this certain amount of debt. We'll let several weeks or a month or two go by, and at that point we'll just remove it from accounts receivable and call it a bad debt expense. So those are the two steps to bad debts. Okay, so those are the two steps to a bad debt. Next is we're going to talk about supplies for a moment here. And recording how much supplies are used is usually an estimate, because generally you're not going to go through and count how many pencils you have, how many paper clips, and all that. So usually it's an estimate. So for example, you would perhaps, let's say you knew how much supplies you had on January 1st, you purchased certain amounts during the year, and then you add those, and that's how much in supplies you have for the whole year. So let's say a count was made of supply storeroom, and often this might be an estimate, and you're not counting every single thing, and you estimate that about $1,200 worth has remained. So 3,000 minus 1,200 is 1,800, and so that's how much has been used during the year in supplies. And so on February 28th, for example, let's say we've determined that we've used $1,800 in supplies, $1,800 worth of supplies. So supplies expense would be debited $1,800, and again that's for purpose of the income statement later on. And supplies have gone down then $1,800 in that period of time, and they're particular to record supplies used during the period. Okay, amortization. That's the next content. Now, amortization is recording how much of your equipment, capital kind of stuff like equipment, any kind of machinery you might use in your business, vehicles, not land, because land doesn't generally depreciate or go down in value over time. Okay, so you do not amortize land. But any kind of equipment that you have, any kind of a fixed asset that has a certain purchase price at the beginning and then it loses value over time. For example, when you buy a vehicle, a truck, a car, as soon as some time passes by, it's no longer worth what you originally paid for it in most circumstances. Now, straight line method is a method of amortizing, or something loses value the same amount every year. That's what straight line depreciation or straight line amortization is. Depreciation is also a word used to represent something is going down in value over time. And there's a formula for straight line depreciation. And this is the formula here. You take the original purchase price minus any salvage value at the end of what you estimate its life is going to be, and divide that by the useful life of the asset. So, for example, if you had, let's say you purchased a truck for, let's say, $50,000, and you figured it had a useful life of, let's say, 6 years. At the end of 6 years, let's say you thought you could get $8,000 for it. So the difference between those is how much is going to go down in value over those 6 years. So we would divide that by 6 then, and then that would mean that we would be amortizing or allowed to use as an expense $7,000 for that truck every year of those 6 years. Okay, so we would actually be recording that in our income statement as, it would be called an amortization expense. It's how much in value we've lost on that asset over those 6 years, each of those 6 years. So there are some examples here. So how do you amortize? And in this first example here, let's go back to the spreadsheet. We have amortization expense. So let's say something went down $1,000 in a year. So we would debit amortization expense $1,000. And this account here, accumulated amortization, is just a record of how much value that asset has lost over time. So it's an accumulated account, and another month will add another $1,000, and another month will add another $1,000 to it. And the particular is the amortization for the period. So the expenses you're keeping track of for your income statement in, let's say, over a year, how much you can record as expense for that loss in value of the asset. And this is a track of how much it's gone down in value over a longer period of time. If something, now the other method of calculating is the declining balance method, which is used in a lot for equipment such as a vehicle. Vehicles lose their largest amount in the first couple of years and less as time goes by. And so that's why there's generally a percentage amount here. So the amortization expense that you're allowed in any 1 year is the original purchase price minus how much has been taken off to date, amortization to date, times some amortization rate. So in the example they give here, for example, so let's say that an asset was purchased for $20,000. In the first year, this is what the calculation would look like. We would go 20,000. So at the end of, if it's the end of the first year, then we haven't amortized anything yet, times 20%. And so in the first year for that asset, we'd be allowed to use as an expense $4,000. Well, now for the next year, it would be 20,000 minus the 4,000. We've already taken $4,000 off its value. And so in the second year, you'd be allowed to use $3,200 in expense for that one. Okay, so that's why it's called declining balance, because you can amortize or use an expense a smaller amount each year. The next year would look like this. We would go 20,000 minus. Now, in the first 2 years, between the two of these, we've accumulated $7,200 in amortization. So this would be 7,200. That's what would be in that account times 0.2. So in the third year, you'd be able to use $2,560 for the amortization expense for that particular account. And that's the end of this tutorial.